Good morning, everyone. Welcome to this third webinar in Quantima's Financial Fortitude series. We'll just give everybody a couple of minutes to settle and start at 9:32. Okay, good morning, everyone. Welcome to this third webinar in Quantima's Building Financial Fortitude series. My name is James Ashton. I'm a financial journalist and author, and I'll be your chair for this morning's discussion. Financial Fortitude from Quantima is aimed at advisors and businesses alike. It's a tough time right now, and it will continue to be so when we eventually come out of the pandemic. We've had a shaft of light this week from vaccine approval, but the high street in turmoil reminds us that significant parts of the economy are still struggling, at who knows how many more administrations we will see going into 2021. Businesses will need significant levels of resilience when it comes to managing their people, money, and market opportunities. This Financial Fortitude programme comprises a series of articles, videos, and events to provide practical insights into what's going on right now, and aims to take people from crisis planning right through to looking at the longer-term strategy. Last time we explored the UK economy and the path to recovery, and there's a write-up of that session on Quantima's website. This time it's mergers and acquisitions, invest or divest. What does the outlook for deals look like in 2021? We know that animal spirits are back at the global level, led by the tech and finance sectors. This week alone, we've seen S&P pay $44 billion for the data firm IHS Markit, and also Salesforce picked up the messaging app Slack for $27 billion. In the UK, RSA, the centuries-old insurer, is being carved up by Canadian and Scandinavian acquirers. Debt's cheap, stock markets are rallying, confidence is coming back, but how do those trends translate to mid-market and entrepreneur-led firms? Please send in your questions as we go, and I'll try to get through as many of them as possible before we end at 10:30 this morning. And I should introduce the panel. They are, after all, the people who will be answering those questions. First of all, I'm really pleased that we have with us this morning Rachel Turner. She's a partner in the corporate team at law firm Harrison Clark Rickerbys. She's an expert in advising on all aspects of corporate work, including M&A, venture capital, MBOs, joint ventures, and her clients range from large international groups of companies to owner-managed businesses across many sectors. Alongside Rachel, we have Amy Crofton. She's a director at the private equity group Foresight, which counts assets of £6.5 billion in total. Amy joined the firm in 2017. She's a director based in their London office, and previously worked at LGB, which is the boutique investment advisory firm, and there she focused on structuring equity and debt investments in UK SMEs. And from the home team this morning, Ian Barton is managing director in Quantima's corporate finance team. Over 20 years, he's advised shareholders on merger and acquisition plans, sourcing funding, planning shareholder restructuring, and he's got specialist expertise in logistics, software, and private equity. Welcome, all three. Rachel, let me start with you. How's the M&A market been for you this year?
Well, thanks, James. I think it's fair to say it's been a bit of a roller coaster. And to set the scene, I'll go back to December 2019, which seems like a different age now. December 2019, in the run-up to the general election, it was quite quiet. I think that people were holding off to see what the outcome of the general election was and to see how Brexit progressed. What we found, and I think other advisors found, was that in January, when there was a little more certainty about who was leading us in the country and that Brexit would trundle through this year, we saw activity increase. And between January and March, we actually found it was very busy. And then obviously March came along. End of March, we had a good pipeline of work. And like many other advisors, that really just fell off a cliff within 1 or 2 weeks. Lots of transactions either stopped completely or certainly stalled. And that was the case through to, I would say, mid to end of May, beginning of June. And then we found that after the shock had dissipated a little and our clients had taken some time to reflect on how this new world was affecting their own business, some of those clients realized that there was a real opportunity. Their businesses were either unaffected by COVID to the extent that they thought they would be, or indeed they were thriving. And that seemed to open the market up a little bit. In mid-market, lower mid-market transactions, they seem to come back on in the middle of June. And since then, we've seen a sustained increase in activity. It's probably strangely and counterintuitively has been one of the busiest times that I can remember. Obviously, that's down to a lot of companies taking stock and looking at opportunities and thinking that they've got to do something.
And just to remind as many people on this webinar, will know of your work, but what are the types of companies that you're advising and what's the region that you cover?
So the firm HCR, we cover really across the southwest, southeast over to Cambridge. That's offices from Cardiff through to Cambridge. I'm in the Thames Valley, which has really been protected. I think this particular region always does pretty well when other regions in the country aren't doing so well. And the kind of clients that we're advising are the deal values are low and mid-market, owner-managed businesses in particular sectors. It won't surprise anybody to hear that that's predominantly the tech sector. Healthcare tech in particular, there's been a lot of transactional work across the firm in that area. We've done some life science transactions, some professional services, and waste and recycling. There's obviously a category of client that either their business has to continue because it's sort of utility based, and even though COVID closes down retail high street, there are some businesses that just continue, or they're businesses that are growing rapidly, predominantly tech, and are looking for those opportunities. They've got cash available, and that obviously is the case for private equity as well. So we've seen a lot of private equity activity, and I'm sure Amy will give us a bit more detail around that. And then groups growing by acquisition and looking at restructuring.
So you almost make it sound like a normal year. We're back to, there's quite a lot of normality there's a bit of everything, really. That sounds like a good, healthy pipeline. I'm going to just turn to Ian and see if he recognizes that trend. Post general election, Q1 was okay, Ian. Then I suppose what you call in advisory circles a period of reflection when the phone stopped ringing, and then everything back in summer. Do you recognize that?
Yeah, absolutely. So the noticeable thing was that most businesses, had to look at their own balance sheets and their own survival and thriving strategies, and we saw that sort of change around June, July time, and that coincided with falls in infection rates and people starting to come back out of lockdown as well. Kids going back to school, and that sort of felt, I think, in September time. There was a normality coming back to the M&A markets and lots of other parts of the economy as well. And as a result, lots of transactions that had perhaps gone on pause in March started to pick up again, and new transactions started to come back and sort of want to discuss what their options were, driven probably by two main factors. One being, potential changes in capital gains tax, which have been well trailed by the government over the last 12 months or so, from their manifesto pledges through to the changes in entrepreneurs relief in March, and now more recently various pronouncements around what may change in the coming years. But also because I think for some vendors, they've seen the pandemic as a period of real challenge, and for some of them that's enough. And where they might have been having thoughts about future retirement, some of that has accelerated for some of them. So there's a real confluence of different factors that have come together. And I would say, I'd echo what Rachel said. I'd say this is probably the busiest I've seen the M&A market, certainly in the last 2 or 3 years. And that I would expect to carry on into 2021 as well.
Quite surprising, really, given where we were just a few months ago. But I suppose, if you're an advisor, you have to, be talking to the clients through periods like this, and then being, ready to act, ready to help.
Yeah, there's always about this blend between buyer and seller, and for every entrepreneur who wants to exit his or her business, somebody needs to invest or acquire it. Now, I think what the pandemic has done is it's brought those sort of expectation gaps from both sides closer together. So in a very hot market, people are going to be pushing for very big prices, and that means that deals might not get done because the expectation gap's too large. I think through the pandemic, people have modified their views. There is greater caution, and so there is greater capacity to form negotiation and bridge those gaps that were there.
Amy, tell us about that expectation gap. I mean, first of all, every seller needs a buyer. So what is the view on the buyer's side in terms of confidence and how that's come back? Has it come back since that period in May, June as well?
Yes, I mean, I think the private equity market generally is in quite good health. There's certainly a lot of dry powder out there. And in terms of kind of appetite for investing, I don't think that ever really went away. Certainly in the private equity world, where typically PE funds have got perhaps limited life funds, so you don't really have the luxury of choosing to sit out 2 years to wait for the world to go back to normal, if it ever does. And other funds, we manage some that are retail funds, and HMRC has certain rules around when that cash has to be invested. So again, you can't just sort of sit on your hands for 2 years and not do anything. There might be some family offices who can, but also we wouldn't want to, because I think actually at the moment, as Rachel and Ian have talked about, I think we all agree that 2021 is likely to be quite a bumpy year, and I think there's going to be a lot of opportunity across a number of different sectors, and certainly for PE like us, where we can invest in growth capital deals, buyout transactions, and sort of equity restructurings, balance sheet restructurings. It's sort of lining up to be a really good year. So we wouldn't want to be stopping now. Unfortunately, the industry's got a lot of cash to spend, so bodes well.
And just remind people on the call who don't know Foresight so well, the type of deals you're doing, the people that you're working with, because there are institutions there, and also those family offices, as you say, who do have the luxury of sitting out 2020 if they wanted to.
Yeah, so we're a bit of a broad church, really. So Foresight has $6.5 billion under management, as you mentioned, but that's a bit cheeky, really, because a lot of that is on the infrastructure side of our business, doing different styles of deals. In the private equity and venture capital team where I sit, we manage about 600 million, and we have a range of different funds. The common thread is SMEs, UK-based SMEs. So we can invest as little as 250k up to about 6 million in equity, and we invest across a range of different structures, from growth capital transactions for younger companies up to buyouts of more mature businesses from owner managers. and we're sector agnostic. So we sort of have one of everything in the portfolio to some extent. Our portfolio is now over, well, I think it's 100 companies, soon to be just over. So I think we get a reasonably broad view of the UK SME landscape through doing that work.
Well, I'm sorry to go with the 6.5 billion. I mean, that's my journalist training. I just look for the biggest number and try and put it in the headline. So I'll stick with the 600 now. Can you address this point about expectation gap that Ian brought up? Are you finding it's helpful? I mean, our owner operators, owner managers that are talking to you, dropping their price, or how is the conversation going?
I wouldn't say we've seen a massive change in price expectations, but there is a real difference between the growth capital world and the buyout sort of majority transaction world. In the growth capital world, expectations are still high. They have been for many years. It's a sort of feature of that market. There is a lot of money chasing relatively few great deals. So that's sort of, it is what it is. And we use various tools to kind of bridge that expectation gap, things like structuring and management ratchets, things like that.
And what is that? That's the natural bullishness of the startup, is it? Where you have to condition yourself to think, well, I've got this brilliant idea, I'm going to take over the world.
Partly that, absolutely. And we see our fair share of lovely hockey stick projections from management teams. Expect that there'll be a unicorn inside of 3 years. Great, I wish you well. But I think largely it's a feature of the sort of supply demand in that market. As I said, there's a lot of cash chasing good growth capital deals, but unfortunately there's often quite a lot of rules attached to that cash, especially if it's from the likes of VCT or EIS funds, which mean that not all companies qualify for it. And therefore there's a lot of cash chasing relatively few deals. So that's a feature of that market. I think the buyout world is slightly different. We haven't seen, I don't think, a material change in terms of expectations yet, but I think everyone's aware that there could be this sort of cliff edge change in capital gains tax in March, April time. And therefore, the economics for an owner manager might change overnight at that point. So I would have thought it may have some impact on pricing sort of now and going forwards.
Okay.
But structuring is probably how you get around all these things. Using more deferred, earn out, all that kind of thing. Because trying to value a business that's had a massive COVID bounce or a big COVID hit is really difficult. It's an art, not a science. And trying to work out what the maintainable EBITDA level going forward is tricky.
It's much easier to draw a hockey stick if you start in April 2020, though.
Yes.
Rachel, I'll come back to you. I'm really interested in your view on when and if CGT might equalise, and what have you been advising clients about that?
It's really interesting. There's a different schools of thought. I think the one thing that is agreed by everyone is that tax is going to have to go up at some point to deal with the huge sums that are being pumped in at the moment, necessarily so. I think my view, and we've had a lot of clients that have come to us with a nervousness about waiting on transactions. I think the first thing to say is that most transactions, if they're not underway at the moment, it's going to be pretty tough, and you may not get the deal that you necessarily want in terms of terms if you start after Christmas and you want to complete by March. I think my view is that it's unlikely to be March next year when the tax rise happens, because it's a really fine balance in making sure we don't stop the economy in its tracks. More likely,
it just feels like it will totally change the narrative. I mean, Rishi's very, very popular at the moment. I mean, I think he's the most popular chancellor since Dennis Healey. That is just because he's giving away money, and for him to suddenly, flip within 4 months, I don't know. Well,
so the commentators that I've been looking at are predicting it's 2024. Which of course would coincide with another general election, and it would have to go into their manifesto, which wouldn't be particularly attractive. I think the point here is that none of us know for sure. And those that are looking to exit in the next 4 years have got a difficult decision to make. Do they jump in the expectation that tax is going to go up? But, it's been a tough year. We don't know what's going to happen. We don't know whether we're going to have a Brexit trade deal. We don't know if the COVID vaccine is going to work long term. I think I'm an optimist. I think it will. But there's a lot of unknowns at the moment. And so I think that's going to drive deal activity, certainly Q2 onwards in 2021.
And Ian, your view, do you share that view on the timing of CGT? I mean, I would think midterm is the easiest way to, it's a very, very unpopular measure for the traditional Tory voter. So I would have thought if they try to slip it out midterm and then hope the electorate have forgotten about it by the time Boris tries to get our vote again.
Yeah, I mean, I think it's a relatively small group of people who impacts, and you would naturally expect that the majority of those would be Conservative voters, but they did trail it. It was in the manifesto for December last year, and they did enact it a bit quicker, I think, than most people expected by bringing it in March. And of course, in March, COVID wasn't really expected to have an impact in the way that it has turned out to do. The point about CGT, though, is it's a relatively small revenue raiser for the government. I mean, it's a few billion compared to VAT, income tax, or corporation tax, which are in the hundreds. So it would impact disproportionately a small group of entrepreneurs and business owners. I think
and then do you have people saying to you then, some clients are saying to you, I guess there will be those entrepreneurs who are wavering, you're thinking, I've had enough, it's time to get out. But there must also be a subset as well who are saying, this is the time, there are really great opportunities now when there's sort of the rubble all over the ground and so on. So you have a bit of both, do you?
Oh, absolutely. I mean, the CGT point is really about the personal risk profile of the individual entrepreneur. And I would say I've seen the full range of people who say, I don't think it's going to change at all, to people who are very concerned that it will change in March, to people who say, well, look, if it changes and it'll be what it will be, but I'm going to keep running my business and I'll exit at the right time for the business, not driven by tax. So lots of different views. I think, in terms of the opportunity that will create is that I think people will generally have reappraised their view of when they want to sell their business. All entrepreneurs are entrepreneurs for a reason, and that is because they spot opportunity and they exploit opportunity where they can, whether that's just in the day-to-day business or whether that's exiting the company at the end. And so, people are alive to taking the opportunity when they see it. Today, what the rules are. We don't know what the rules will be in the future. We know that they will change. The question is really twofold. It's timing and it's quantum. They're 2 points, of course.
So that day the rules change, Ian, is not a day for you to book the afternoon off.
Well, I certainly hope not.
No, definitely not.
There'll be lots of businesses who continue, and CGT is not a big factor for them. Yeah. Equally, there are things like employer ownership trusts, which have come much more to the fore, which are CGT free, if you like, ways of selling your business to your staff. And I think this whole change in society of bringing things together and people being a bit more sharing and a bit more open, I think we will see some of that cultural change in the deal market. And of course, there's a big benefit for entrepreneurs as well.
And considering the broader quantum, I mean, I'm interested in to what extent the other things that the company operates in. There's the restructurings and insolvency, there's forensics and so on. I mean, a lot of this stuff must feed into M&A. We shouldn't forget there are a lot of companies out there that are in severe distress.
Yeah, so there are 2 types of M&A in a way. There's the defensive type of M&A where you're selling a business or you're finding investment because you're trying to salvage value, so non-core divestments, or you're trying to safeguard your markets. And of course, those businesses, the seller is selling because they need to sell. There's a necessity.
Yeah.
If that could be owned by another party, another company, another individual, a private equity firm who can see that value and is prepared to invest in it because it's, they see the opportunity for themselves. So, we are seeing, an increasing number of restructurings, not necessarily formal insolvencies as such, because, the government funding schemes have provided lots of protection for businesses. But as those schemes unwind and end and start to be repaid, I think, sadly, we will see lots more of that restructuring, and that will drive, as you say, sort of that distress M&A, an opportunistic M&A in 2021.
And then the other side is the opportunity. Yes, so defensive, opportunistic. I see that. And I'll turn to Amy to talk about the interesting about the role of the banks and the lenders in these deals. Amy, do you see what is their risk appetite, seeing as there is quite a lot of debt in the system that they need to repay, forgive, or deal with?
Yeah, so I think so far we haven't seen a material change, but perhaps at the margin we've seen the banks sort of get slightly more reluctant to lend to the SMEs and the kind of SMEs that we deal with. They've been heavily distracted over the summer by CBILS doing all those kind of loans, and I think sort of generally speaking they've done a really good job of that. We've used CBILS quite heavily in our portfolio because sort of why wouldn't you, if it's interest free for a year, it's there to sort of make sure you've got a cash buffer should the worst happen. And I think it's done a very good job of propping up companies through a difficult time. I think your question probably is more relevant to 2021, and we might see then just getting a bit tighter on terms and enthusiasm for backing small risky companies, but we'll have to wait to see.
But not yet. Ian, and do you echo that, Ian? Have the banks started tightening up yet?
The banking market is still open for business, and I think, personally, I would have expected it to be a lot tighter than it is. But I think the banks recognise that the CBILS market, as Amy says, has provided an extra bandwidth into portfolio businesses that they might have already provided lending to, but also gives them an opening into new relationships as well. And we've seen that very much with the peer-to-peer lending, where they have seen this as an opportunity to go and take some market share. Certainly in the banking conversations we're having, there is a deep understanding of the challenges that these businesses have. There's no general desire to pull those businesses over or to give them real challenges. There is a lot of positivity and softening of covenants, providing extra funding through CBILS and the like. What we are seeing is that where there are good opportunities, banks remain open for business. They're more tempered in terms of the rates that they charge on interest and the term of the facility and the repayment profiles. But they are very much open for business and are supporting the deal doing market as well as their existing investment.
Okay, interesting. Do ping through questions for the panel if there's anything you'd like to ask them. And I've got plenty, but please do send something through. As I say, we're going through until 10:30. Rachel, let me come to you. As you said, it got busy in May and June again for you. What I'm interested in is how doing deals changed. There was a lot less face-to-face, obviously. What did that mean for timings, because if you're an entrepreneur selling your company, it is a very, very emotional time. So I'm interested in how it went, how you adapted.
It's a good question, actually, and I think the answer is it's not straightforward. It really depended. There's two categories. One is the process, and two is the actual negotiation and settlement and completion of the deal. And the latter depended on which sector you were in. Some businesses heavily affected by COVID, so the process for example, due diligence focused very much on Brexit readiness, COVID effect, normalising the business, taking into account how things were going to be projected forward based on, at that point, nobody knowing when a vaccine would be available. I think Amy's already mentioned there was that there has been more deferred consideration and earn out to sort of spread the risk between buyers and sellers. And those businesses that have been impacted, the negotiation tends to be a bit more less commercial on the risk than I've experienced before. And I think that is driven by the fact, we go back to the word shock, none of us expected this to happen. And so it's people or clients and buyers have thought about risk in a slightly different way. Other businesses which have thrived through this crisis, the change came in process. As you say, we couldn't meet people face to face. We had an interesting discussion here about how long it would take and what the budget would have been if we'd had to set up an entirely remote operation. The fact is, we did very quickly, like other businesses. It's worked very, very well. We use DocuSign, which is an electronic signature platform. And without that, I think it would have been very difficult to do some of the larger transactions with lots of parties involved. So the short answer is it's actually worked very, very well. The transactions where businesses, clients have been really badly impacted or significantly impacted by COVID have taken a little longer to settle. The due diligence has been the focus, but the deals have still been done, and that was a surprise for me. I thought that things would take a lot longer and the appetite for risk would have reduced quite a lot, but that hasn't been the case.
So you know, on that point, because this is the year when people have been a lot nicer to each other. I mean, does it mean that then there've been more generous negotiations, and if so, do you see that going through into 2021, or are we back really much more combative?
I would say it's the opposite. It's not people have been generous, going out clapping for the NHS and looking after people on an individual level. But of course, this is business, and where you might have taken a view on a transaction in the later stages of negotiation on something which you would think is an ordinary trading risk. When you've got to justify a transaction to your investors, perhaps, there's just a deeper look at those unexpected events than before. That's my experience. And it can be demonstrated by corporate lawyers often advise their clients, well, look, what's the worst that could happen? What's likely to happen? Well, this year has shown that the things that we think are incredibly remote has happened, and that has changed some attitudes. However, deals still need to get done, and it comes down to the attractiveness of the target in front of you and how much your buyer really wants to bolt you into their portfolio. So it depends on the bargaining strength of the parties. Yeah.
Amy, has your appetite for risk increased, decreased, given the events of this year?
I'm not sure there's been any material impact, to be honest. I think perhaps there's a difference here between a trade buyer and a private equity investor, because a trade buyer exactly may not have thought about sort of really existential risks like a global pandemic, or, I mean, I'm not claiming that we spent a lot of time thinking about it either, but our day job is sort of assessing risk and return. So I think probably it hasn't really dramatically changed our sort of assessment techniques of businesses, other than, of course, we're now having to think about modelling or kind of scenario analysis of exactly what happens if the vaccine doesn't work, what happens if everyone reverts completely back to normal. There's several scenarios you can run through, and we probably wouldn't have done that previously. So that's how we kind of do the calculation on risk, I think.
Ian, Rachel mentioned the B word. I'm interested in your view. How does Brexit feed into M&A 2021?
Going back a year, it was hugely impacting the back end of 2019. that and the election and the uncertainty that that was causing. And certainly as you went through transactions at that stage, it was always, well, you know, how does this impact the business? What happens if various scenarios play out? I think people sort of largely came to the conclusion that they could manage within that, and they were starting to understand the rules. And, you know, my view of business is always, business will always adapt. It just needs to know what the rules it has to play by. And that, I think, is why we saw this boost in activity in January to March, as Rachel mentioned earlier. What we're seeing in the last 6 months or so is that Brexit almost has gone under the radar. COVID has dominated the headlines in every part of our lives, and almost Brexit got forgotten until almost the last month.
Well, I love Rachel's word earlier on. I mean, she said Brexit trundling on, and as we sit here now, we see the headlines this morning. It is still trundling.
It is, and you know, we're now in the final days, we're told, because the EU summit on Thursday, and we have to have something agreed. EU deals have always been done at the very last minute, and you know, I think it's almost unimaginable that there won't be a deal of some sort, whether it's a headline deal this week with the detail to follow in the new year. I just can't imagine that it suits any party, including the economies of all of the EU nations, including Britain, to not have a deal.
Yeah.
So there will undoubtedly be change from the 1st of January for businesses who are importing or exporting, and that's a very large part of the UK economy and the mid-market that we're talking about, you know, on this webinar. So I think it's sort of, it has come more to the fore, but equally in the same week that we're talking about the vaccine, and so even now Brexit is almost on the back burner in terms of public consciousness. I think very much people just thought it was done, and it's only in the last few weeks that people have realised it isn't done. Businesses are very conscious that it hasn't been done for them, and you know, they're a little bit sort of, well, I don't know what the rules are yet, but I know it's going to change. I know it'll be more different. I know there'll be a hiatus in Q1, perhaps as we get used to new ways of doing things, but we'll get through it and we'll work out a plan from there.
As long as that vaccine doesn't get stuck in Bruges or something. That's the important thing. Amy, I'm interested with this international dimension, when you're the types of companies you're up against, if you like, when you're looking to invest. Maybe this is more relevant for the buyouts. Have you seen? Are you competing with overseas investors in some of those deals, and are they there in numbers that they were? And do you think they'll come back?
I would say we do sometimes compete against international trade acquirers, but we offer a really different solution. So I think if we're competing against a trade offer, it's not usually a straight kind of price and terms argument. It's more about what does the manager want to do with the business, how long do they want to work in it, what growth opportunities are there, etc., etc. So it's not something that kind of makes a huge difference to our the outcome of sort of our structuring or pricing or anything like that. I think it's probably true that we did have some opportunistic trade acquirers come and look at our portfolio for buying some of our existing companies, probably more last year when the sort of the currency movements made it quite advantageous. I think that has probably slowed slightly at the moment, but may come back in 2021 once Brexit's done in whatever format that means, and when everyone's got a bit more clarity. Not huge. I mean, we probably don't sell. We sort of sell on average kind of half of our companies back to private equity as sort of a bigger player than us, and half to trade. And within that trade, I'd say the majority are UK-based trade.
Okay. Question from Roger Gregory, who's watching. Do you think the National Security and Investments Bill will have an impact on M&A activity? I don't know if Rachel, do you have any thoughts on that?
Yes, just say hi to Roger. I know Roger. It's interesting, actually. We worked on a transaction very early on this year, before COVID struck, that was stopped by the CMA, and that was because of the government clamping down on investment by foreign entities. That was the first time it's happened, but it was a really interesting process. I think it is going to have an impact in the short term, while the body of legislation that's going to be brought in, and obviously this new legislation is relatively new. I think there's going to be more, and foreign investors are going to want to see that whole body and have it settled for a period of time before they make any significant investments.
And Ian, your thoughts on that? This is just looks like, as Rachel says, this is increased scrutiny.
Yeah, and you know, I guess Rachel's transaction can count itself fairly unlucky, because you know, it really was a handful of deals that were scrutinised in this way, and the view is that the new, you know, when this bill is passed, you know, that could bring many hundreds of transactions into the purview of that review process. So ultimately it will, and as we were just talking about on that last question, you know, this is really about foreign investors investing in UK businesses, and particularly things that have got, you know, impact on the national infrastructure and the like. I guess the one thing I would say is you know, it potentially is a form of protectionism in a way, and that is a global phenomena that we haven't seen for many years, where free trade has always been the focus. But you know, the rise of some sort of you know, political ideologies around the world, and we've seen in the US, you know, that the insularity that Trump brought to that market. You know, in a way, this is a bit more protectionism. Clearly, it's driven for good and proper reasons, to protect the economy from nefarious investors, if you like, rather than genuine people who will bring money in. And I mean, only the other day we saw that you know, they're relaxing the rules on COVID for you know, foreign business people who are coming to the UK to invest or to make growth. So you know, the government is trying to encourage that investment, but block out certain parts of it. It will impact, and it will impact more and more. Hopefully not so much within the lower mid market though, where we mainly operate.
James,
please, yeah.
Sorry, I was just going to add something. It's not directly linked to the question, but it is directly linked to overseas investment, and it's anecdotal evidence. But we have an international team here with 3 Chinese nationals. The message coming from them is that Chinese investment last year was at record levels. Since COVID struck, there's been very much a reduction in the willingness for China to invest in the UK, and what they're waiting for is to see the settled Brexit deal and how the vaccine works. So that's been quite interesting for our international team here to see that reduction, but particularly linked to Brexit.
And on the Chinese side, you know, as we've discussed before, they do seem to have discovered this idea of antitrust competition, and actually the deals that Chinese companies were doing looking out into the world that maybe weren't getting the level of scrutiny before are suddenly going to be getting scrutiny in the home market, particularly some of the bigger tech firms. Yeah. Amy, I'd like to turn now to some of the sectors that we think are interesting now and interesting, you know, going forward, where the activity is. You talked about tech and healthcare, and I'm just interested if there are trends that are coming out of the period of lockdown and the pandemic that have become more interesting to you. I mean, I suppose healthcare is absolutely one of them, but even things around computer games. You know, it's been a bumper year for stay-at-home leisure pursuits. So, how are you viewing the opportunities looking forward?
I think actually that's one of the most commonly asked questions. Have I got a bit of reverb there? Okay. One of the most commonly asked questions at the moment is sort of what is private equity looking for going forward in terms of sectors? And I think there isn't really a simple answer to that, because you might think healthcare, logistics, e-commerce, all those kind of areas that have done well out of COVID. But within each of those sectors, I think we've seen that there are real winners and losers depending on exactly what this model is. So, I mean, within our own portfolio, we have a few healthcare companies, the majority of which have absolutely flown through COVID, and it's been a real boon to them, and has given them, you know, lots of cash reserves they didn't have before. So now they can think about acquisitions and developing their business. So it's been great. But we've also got healthcare companies, one in particular, which is doing clinical trials, and the trial was just put on hold the instant sort of COVID happened, because hospitals were doing it, nothing that wasn't COVID related. I think you've kind of got to dig deep. And also there are other sectors that people would assume private equity wouldn't be interested in going forward. Things like leisure, bricks and mortar retail. But again, even with them, I think there could be real opportunities in those sectors. As we've talked about before, you know, some business owners might have a really solid business. They just can't necessarily face the next 2 years of hard graft to get back to where they were. Only to have perhaps some of that value creation taken off them in tax. So we may find some really interesting opportunities in those sectors, especially as the weaker players may well be lost once the sort of CBILS unwinds, etc., and the sort of artificial propping up has gone. So we haven't taken any kind of hard and fast rule about which sectors we're looking at. We're just applying a sort of case by case lens to it. And I think we'll continue to do that.
Ian, what do you make of sectors? Because I mean, you know, as Amy points out, there are some sectors in real strife, but there does still, you need to be winners in those sectors. There needs to be opportunities. There has to be something that fills our high streets in 2021 and beyond, for example.
Yeah, look, absolutely. You know, the shape of this recession was like no other, in that it was absolutely immediate. And so, you know, lots of businesses were just completely caught unawares, would never have expected to have found themselves in difficulty in 2020. And you know, as you say, those businesses driven by, you know, consumer spending, whether that's, you know, retail or restaurants or leisure, you know, people will come back to that, but they will come back slowly, depending on, you know, the success of the vaccine and how social distancing plays out. I think, as Amy said, there will be winners and losers even in those very challenged sectors. So, you know, whether you're in aviation or whether you're in retail, you know, sadly, some of your competition will fall away. You, if you're in that sector, might not think that your competition falling away is necessarily a bad thing. And so you may come back stronger as a result. There is a potentially slightly smaller market than there used to be, but there's less competitive pressure in it. And so, you know, I think we will see those businesses that do survive actually being, you know, stronger and more robust as a result, albeit the overall message about those sectors will be that they'll be challenged for some time. You know, equally, you see things, you know, like the property markets, you know, which are incredibly, you know, challenged on the high streets and city centre locations. But what that does is it causes property that perhaps it might never have ever come on the market now to be available. And if you are an investor with cash, and you know, there are plenty of investors with cash, there is an opportunity to buy things that you could never have got your hands on in the past. And I think, you know, those value investors, we will see more and more of that in whatever sector it is.
So it is about that. It is about requiring that bravery in those, particularly in those tough sectors, or fortitude, mainly. This maybe that's the word. Yes,
well, that would be a very good word to use, James.
Yeah. Rachel, let me turn to you. What you gave a really good assessment at the top of this about. You described it very much as a kind of a broad-based recovery, that with deals coming in from all places. Are there any specifics you would pull out, any trends that you've seen, you know, whether it's particularly hot in one area? And then I'm going to come on to a question from Sean Taylor, who was interested to hear any thoughts on battery, cyber, AI, and where ESG plays in any of these transactions.
Well, I can probably comment on Sean's question as part of the first part of your question. I think it's tech all the way. We're predominantly working with tech companies, but tech is not just the typical software. It's fintech, it's e-commerce, there's lots of platforms out there. It's disruptive technology, including in manufacturing. So tech in the widest sense. So anything that is designed to make a a process or a product easier, more efficient. So talking about batteries and energy, there's a lot of energy investment into sustainable energy producers. I think there are some interesting areas that I've been reading about. For example, food manufacturing at the moment during COVID has skyrocketed. The supermarkets are doing so well. I suspect that once the doors are open, there'll be a period of everybody going out and spending what money they have. Of course, there is a body in society that has suffered incredibly badly and they don't have that money. But for those that do, I think there'll be a huge resurgence in leisure and hospitality. Question is, will the property still be there? The point that Ian was making about property, and we've been looking at Reading Town Centre and Debenhams closing. What do you do with those properties? Do you repurpose them as leisure activities? We think that that's a possibility. That can't happen until we're pretty certain that social distancing is no longer required. But you can't go wrong with tech. I think that it's in the forefront of everybody's minds, but tech in some of the most unlikely forms. Tech includes the life sciences, that small invention that makes the operation simpler. So yeah, that's but particularly in sustainable energy and electric cars, that kind of thing. I think that's it hasn't been affected and it will continue to grow.
Ian, a question from Sharon Murphy. Are you seeing any impact from the HMRC change now being treated as a preferential creditor ranked ahead of bank debentures for VAT and PAYE liabilities? Is that driving M&A?
Well, it's only just changed. It's a very recent impact. I think what we will see is, we referred back to how the banking market is behaving at the moment and what they might do in 2021. This will impact them in particular, because in transactional deals, the bank always ranks at the top of the list in terms of creditors. But this is a reinsertion of HMRC ahead of some of that banking ranking. And so the net result is going to be that banks are going to be more reticent and more cautious around their lens, because a fairly large creditor is going to sit ahead of them. And let's not forget that the government has extended very generous schemes around VAT deferral, around corporation tax deferrals, for private individuals, around income tax deferrals. And if all of those things now rank ahead of the bank in those sorts of scenarios, that is going to make banks more cautious when they come either to restructure transactions they're already involved in, or putting money into new deals in 2021.
I think it was very interesting. I think Arcadia beat the change by a few hours. I think it was just before HMRC got preference. I don't know what that would have done, what that's done to the process, but it was just curious. They seem to be racing to beat that 1st of December switch. Amy, I'll come back to you. Interested in two things. The ESG point that Sean raised, is that something that feeds into the type of deals that you're doing? And then I suppose I'm curious, I guess, as you said, the thing you get asked the most is what type of companies do you want to invest in and back? I'm also interested in the type of person you look for, because so often the person is the company, at least to begin with.
Yeah, so with the ESG point, I think back maybe 5 or 10 years ago, you had specific ESG funds who were just purely focused on, social, sort of very socially beneficial enterprises or environmental technology or whatever it was. That world has now changed, and pretty much any fund now absolutely has to have ESG as a kind of central point, and it's driven by the investors. Our investors, when we have discussions with them, they bring up ESG in every single meeting now, and it's not a lip service tick box exercise like perhaps it was once upon a time. So we take it incredibly seriously. As investment managers, we have to write sort of specific ESG focused reports on all of our companies. We have it as an item at every board meeting and every company that we sit on the board of. So it's huge, and it's only getting a sort of bigger piece of the investment criteria, and I can't see it going the other way anytime soon.
It's still so amorphous. I mean, if you ask people to define what ESG is and what they want from it, I think a lot of people would struggle.
Absolutely, and we've been through a sort of big long process of defining what it means to us, and we have a big long sort of tick list of various criteria. We have a sort of in-house dedicated resource focused on ESG.
Yeah. So it's interesting, actually. So in a conversation with a company that you might be looking to buy out or back in some way, you actually have the conversation, say, look, we're really interested in what you're doing, but we think your emissions are too great. Could you do this? Could you do that? And then we'll come back and we'll really want to back you.
It's largely about sort of showing improvement. So there are certain sectors and certain companies we just wouldn't touch because they, we're not going to start backing an arms dealer, etc., etc. There's certain things which just fall foul of the principles, full stop. But when we do invest in a company, we try to work out the 3 to 5 areas within ESG, and these are specific practical points where we can improve them over time, and then we measure them quarterly to ensure that we are actually doing something about it. And you're right, it's amorphous. So for each company, it has to be really specific to that company, because you can't just generally say, think about diversity. That doesn't sort of cut it.
No. We're coming up to the end now. So 2 quick questions to fit in. First of all, from Anita Pickersgill. I don't know if this is one that you have a view on, Rachel. Can you see HMRC being more rigid on the length of time to pays, one size fits all, etc., maybe more walk-in possession orders?
So I'm not an insolvency lawyer, but I know, having done this long enough, that HMRC, one would hope that they'd be slightly more forgiving at the moment, but we have a specialist tax barrister on the team at HCR who was with the revenue for many years, and just recently I asked her a question about whether HMRC would take a particular view. And as a corporate lawyer, I'm used to dealing with people who sort of solve problems and work together and are pragmatic and reach a great outcome. And she kind of laughed at me to say, no, that's not how HMRC works. If it sees money available, it will take the money. So it's not a scientific answer I'm giving you. It's just my personal view that it's unlikely. I don't think it will be the case that HMRC are going to give any leeway.
And this might be finally, Ian, but from Mark Cottam, this point, do you think affordability replaces term and covenant?
I think affordability on any debt lending has always been, the watchword of banks. I think particularly there is an increased focus, and it is an increased focus because it was always a focus to start with, around cash headroom and therefore the affordability. And I think what we will see is greater headroom being required when considering any lending. Certainly we're seeing that in transactional world, whether that's private equity or whether that's corporates, that there is a real focus on, what are the cash flows of this business, what happens if, the scenario planning, but also understanding what the repayment profile is of bank debt, and in particular anything that's been deferred. So, often we're now seeing transactions where businesses have deferred their VAT, have taken in a CBILS loan, and that will need to be repaid. And, I do largely expect that, going back to the last question, I do expect that HMRC, has a softened stance. If you are paying, if you're doing the right things, if you're having the conversations early, then I think there'll be more flexibility in those conversations. But those debts do need to be paid. And so, affordability is going to be an absolute focus because there's a new lump of debt that sits ahead. And as we talked about earlier, HMRC has got this new preferential right, and there's no point having the right if you don't use it, quite frankly.
Yeah, exactly. Excellent. Thank you. So in summary, I mean, this is really something great to bounce into the weekend with. We do think it will be a bumper year in 2021. Lots of opportunities for the people that want to take them, almost regardless of how Brexit turns out. and you know, tech all the way, as Rachel says. Lots of tech about platforms and new applications and things that disrupt and do things easier than before. Thanks so much to everyone who's tuned in for this, and I should say thank you to our panelists for their very full and honest answers, to Rachel, Amy and Ian for taking time out of their day. For any questions we didn't have time for, please follow up, ping Ian a note, or we can help with addressing any of those questions. We hope you found the webinar useful. Please do join us for the next one in the series. We'll have more information on that in good time as we go into the new year. And as mentioned earlier, please take a look at our Building Financial Fortitude programme. There's lots of articles and video clips available on the website. The wider programme can be found now, as it says on the slide, quantuma.com/fortitude. So it just leaves me to say thanks for listening and good morning.